you really need to have to do with it. It's just going to be live streamed on our channel.
Okay.
Good. I think we can, it's 6:30. We can start at 6:31, which is now.
Okay.
You really need to have to do with it. It's just podcasting. Mute. All right. Good evening, everyone. Hi. Is everyone able to hear me? I'm assuming yes, because my little mic on the side is ticking. Welcome to today's webinar hosted by Sharesight. I'm Himangi. I'm happy to be your host for today. For those of you who are not familiar with Sharesight, we're an online portfolio tracker and a reporting platform committed to simplifying complex investment data for all kinds of investors. So whether you're a beginner or you're an experienced investor, our platform is here to help you track your holdings in one place and help you understand your portfolio's performance through our really powerful reporting tool. So today's session, we are going to be delving into the secrets of successful tech and AI investing, the Buffett way, with our esteemed guest, Mark Moreland, who is here with us. He's the co-founder of Team Invest. I'll just give a little brief intro about Mark, but I'm sure we all really know Mark very well. As you know, Mark is a seasoned entrepreneur and a visionary. He spearheaded investments totaling up to 4 billion in listed equities. He's bringing 40 years of experience along with his invaluable insights today. He's also the director of the CCF Conscious Investor Wholesale Managed Fund. Additionally, Mark's also got a new venture called the CI Method, which aims to aid investors globally in achieving financial independence. So for the next hour, Mark will share his tools and strategies to navigate through this dynamic sector of tech and AI, obviously for investors of all levels. Now, just some hygiene before we begin. Please treat this as general advice. We want this to be an interactive experience, so please don't hesitate to join the conversation in the chat box below. And you can also leave your questions for Mark in the Q&A box separately, and we'll have some time towards the end to answer them. Okay, without further ado, over to you, Mark.
Excellent. Thank you very much, Mangi. That's wonderful. I'll just get our slides working. All right, so this is our disclaimer. So obviously, this is general advice. We do not have a personal advice license, and we do not give personal advice. So please make your own investigations and make your own decisions on what you invest in. Who is Team Invest? Just very, very briefly, we're a private membership organisation for those who wish to educate themselves to manage their wealth wisely rather than pay others to do it poorly for them. And it's shared wisdom for long-term investors. And basically what we want to do is understand the best businesses really well. We are very much based on Buffett's methodologies. We've been going for 16 years in Australia, and we have over 600 high net worth members who collectively have about 4 billion invested in equities. So they use our process and our system with the target of 15 to 20% compound return on average over a rolling 5-year period. That's what good looks like from our point of view. And tonight we're going to go into, or just before that, our aim is to be better investors for long-term wealth creation and preservation for ourselves and our families. So I had one more slide there than I thought. So the agenda tonight, why invest in our AI and tech? It's obviously the flavour of the day at the moment, and we're going to talk about how you can do that successfully. So it's when to invest in a particular business. So we're not investing in the industry, we're talking about individual businesses, and then how to invest profitably. That's very important. And what's Buffett's principles, and are they still valid? So we're going to explore that. And how can you use his methods to avoid losses and compound your wealth meaningfully over the long term. We're into compounding. As I said, we look for 15 to 20% compound return, and that is absolutely achievable, by the way. It's not like a wish list. We do achieve that. And we have a very interesting Buffett report, which actually takes his principles and shows you how you can apply them in the market and how we do that. So that's going to be in the chat. If you'd like to click on that, you can download it. And at the end, I've got a QR code you can click on as well. So without further ado, we'll get going. So why are we discussing AI and tech? Well, advancing technology is going to impact all businesses. That's the fact. It's going to disrupt industries. It's going to enable new markets. It's going to erode incumbent moats. Everyone knows what a moat is. It's like a strategic competitive advantage. What's going to stop a competitor taking a particular business's customers away? So we want moats that are very, very strong, and we'll talk about that a bit more in a minute. And it's going to create new industries, and it's going to challenge management agility. We think this is a really big one, because if you look at existing companies in Australia, and if you agree that AI is going to affect all of them, and it will, by the way, and I could give you heaps and heaps of examples, but we haven't got time tonight, and how well the management adjusts to that and how well they capitalize on it and how they use AI in their business is probably going to be the difference between whether they're successful over the next 5 years or they're going to be out of business. I think that's how significant it is. So it's not just about tech companies and AI companies, it's about existing businesses and how they deploy it. And a lot of that comes down to the actual management, and do they have a founder mentality? Are they entrepreneurial? And do they recognize the risk and the opportunities? Because it goes both ways. In recent decades, we've experienced many technology-driven advances: the internet, mobile devices, autonomy, Internet of Things, cloud computing, battery and power technologies, gene therapies. We are living in an exponential age. I think it's the most exciting time in the history of the world to live. And I think as investors, I believe the next decade is going to be spectacular for us, and we can capitalize on it. The last decade has been fantastic for us, and for Team Invest members, it certainly has anyway. And I think that's going to continue, and it's going to get even better because there's going to be massive wealth generation and productivity improvements that's going to be generated through a combination of tech and AI. AI is the latest technology wave. There was 57,900 odd AI companies registered last year alone, 57,000. Now, just like the internet, when the internet came in, there was an enormous number of companies that were created. And of course, we had the dot-com crash in 99 going into 2000, and basically 99% of them got wiped out. And the companies that are still standing from that are your Amazons and your Googles and your Apples and so on, the ones that are now the dominant players. So how do you go from investing in a whole new trend and a major revolution, if you like? How do you pick the companies? So I'm going to show you how you do that. Of course, nearly all these are going to fail, so we don't care about those. So if you look at the Magnificent Seven, which is plenty of press about them in the US, and it's totally justified because they have been driving the S&P 500 returns for years now. Tesla has gained more than 800% since the beginning of 2020. So in 3 years, it's a multiple 8 times your capital over 3 years. Microsoft, even after decades of very high growth, has delivered 11x, so it's 11 times return over the last 10 years. Meta Platforms, which went public in 2012, initially is Facebook, it has risen 841% since then, compared to 362% gain on the S&P 500. Apple has returned over 1,000% in the last 10 years alone, and that's nearly 5 times what the S&P 500 has done. So in other words, a share in Apple for the last 10 years, and it really didn't matter when you bought it, by the way. So anytime you bought it roughly 10 years ago, you've done 5 times more than you would have done if you had an investment in the index. NVIDIA, which is, of course, I'm a shareholder, by the way, and I'm a shareholder in Apple and Microsoft and Tesla, but not Meta Platforms. NVIDIA was added to the S&P 500 in 2001. And a fun fact, it's the company that replaced Enron. If you remember, Enron was probably one of the biggest scandals in corporate history as a fraud. Actually, NVIDIA replaced it in the index. Since then, it has delivered a staggering 12,950% total shareholder return. That's actually, if you put $10,000 into NVIDIA in 2001, you've got 1.29 million. That just puts it in context. It's the power of compounding. This is one of the key principles that Buffett has always pushed, is compounding and why you need to not interfere with it. You want to get into it and keep it going, and I'm going to show you how you do that. So Warren Buffett, doesn't invest in technology, or does he? I mean, he's been quoted as saying, he doesn't understand it, and he likes old-fashioned businesses and all sorts of comments like that. And a lot of people have thought he's been a has-been. Now he's 94. Munger unfortunately died late last year at 99, which is a massive loss. He was a genius. I've been to 13 Berkshire Hathaway, that's their company's AGMs in Omaha. So I've basically been the last 13 years every year, and I'm going this year as well. And I always learn a lot, because they're both incredible individuals with their life and how their philosophies and how they think. And it's a fantastic experience. And usually there's about 40,000 people there, so it's a lot of fun. Oops. So what does Buffett look for? Now, you could have taken this 60 years ago. He was saying the same thing. Buffett has been a principle and a rules-based investor, where he's kept doing the same things forever and hardly ever deviated at all. And he's always said he wants businesses with consistently high return on equity. Now, he says a minimum of 10%. It's also return on capital as well. And we see it as a speed limit to the business. If a company has less than 10% return on equity, which is the capital deployed in the business, you can't get a higher return over 5 and 10 years than that without PE expansion. So assuming the PE is the same, it's like a speed limit on the business. So we like 20 and 30% return on equity, but 10's our cutoff. And interestingly, you might think 10's not a very ambitious hurdle, but if you look at the ASX, there's about 2,200 companies listed. On any given day, there's typically less than 10% of all listed companies have a return on equity above 10%. And another scary stat is, on a typical day, 50% of the listed companies on the ASX have a negative return on equity. A negative return on equity means they're losing money. So why would you want to buy any of those? So it's a filtering approach that Buffett's always used, and it's the approach we use to narrow down the market. We don't care about the market. It's like when the market's up or down, who cares? I mean, what we're interested in is what are our businesses doing and how well are we doing as investors. If you want to buy the market, you buy index funds, and that's fine. And as Buffett says, that's the best strategy for a know-nothing investor. But if you want to be a know-something investor and put some effort and time into it, obviously you need to do better than the index. Otherwise, you're not performing well. And with little or no debt. Now, debt, as Buffett's always said, is a 4-letter word. Debt has now come back into its own. We had a whole period there for nearly a decade where money was just about free, and a lot of companies then borrowed to the hilt. Now that's coming back to haunt a lot of businesses, and we're seeing it. It's a big issue in some of the real estate trusts, obviously, because as they roll over their debts, they're now rolling over at 7, 8, 9, 10%, where they might have been paying 3% before. So it's a massive impost on the business. So beware debt. It's now back. And if you go back to the GFC, nearly all the companies that went broke or really went down during the GFC had very high debt levels. So debt is a capital killing risk. So we've always been averse to it, but it's even more so now. And where you can be virtually certain that earnings per share are going to be materially higher in 5 and 10 years' time. So in other words, you want a company that has solid fundamentals, and these are the fundamentals we're talking about: low debt, high return on equity, and earnings that are growing consistently with stability. And I'll touch on stability as well quickly now while we're here. John Price, who is the creator, one of our co-founders, who created Conscious Investor, which is our software platform that we use to evaluate companies. He was the maths finance double degree professor at New South Wales Uni, and he spent about 20 years studying Buffett. He created this fabulous program called Conscious Investor, which actually has a 22-year history on the Australian market of achieving 18.2% average return per year using the selections out of the program. That's 22-year history. And one of the key things in it is that he worked out a brilliant way of forecasting earnings going forward. And what he found, and he did lots of research through the university, so there was major studies done, then they did an enormous amount of data testing on the US, Canada, and Australia. And he discovered that there's a total correlation between a company's stability, and namely, if a company has, let's say they have 15% EPS growth, if it's 80% stable or better for the immediate past 6 years, that company is 5 times more likely to be on the same trajectory 5 years into the future than another company with the same EPS growth rate, but with 60% stability. There is an absolute correlation with how stable the earnings are, and I can go in and explain why, but we haven't got time, and you can find out if you read our Buffett report. It'll tell you all about it. Buffett's rules, very famous. Rule number 1, don't lose money. Rule number 2, refer to rule number 1. In other words, a double emphasis on don't invest in anything if you think you have any chance of losing your capital. Now, he's not talking about share prices going up and down. He's talking about permanent loss of capital. And that's been his driven mantra, which makes him conservative. And it means that he says no to 99% of the things he looks at. So he's very, very selective. And we mimic that in Team Invest. His rule number 3, focus on the long term. And the reason is that is the way you get compounding working for you. 99% of the market is trading focus, short-term gains, trying to get alpha, betas, deltas, whatever they're trying to get. And the whole industry largely is incentivized based on transactions. They want you to buy and sell as much as possible, is how they make their money. We want to be boring investors where we work very, very hard to work out what to buy, when to buy it, and then stay with it. And the only reason we sell is not because it's got expensive, but because something fundamentally has changed in the business or our hypothesis of why we invested has changed. And that gives you these compound returns we're talking about. It's how Buffett turned $50,000 when he started seriously in business, 50,000, into over $1 trillion Australian now is the Berkshire Hathaway, all through investing. So simply, we want to invest in businesses only where we can be virtually certain of receiving an attractive return. We call these businesses wealth winners. Now, initially, when we spot a company that we think might be a wealth winner, it's a potential wealth winner. And then once it proves it's a wealth winner, it becomes a wealth winner. So I'll come back to that. So what is a wealth winner? To be a potential wealth winner, a company must demonstrate consistently high return on equity. Surprise, surprise, same as Buffett. In recent years, so it's not 1 year, we want at least the last 5 years and preferably 10 years of return on equity over 10% and preferably stable. We want that achieved with little or no debt and have earnings per share that have high stability over recent years as measured. STAG is our term for it, which is the stock return with dividends reinvested in our constant investor program. So that needs to be 6 years. So we don't invest in startups. And if it's a new AI company, we can look at it with great interest. And then we watch what they do. And it's not until, or any company for that matter, until it proves it has a proper business, meets all our metrics, is making money. So basically, we're not going to invest until about year 6 if it's been super successful for the 6 years. Now, you lose the early gains, but not by any means do you lose the returns over a long period. I'm going to show you examples of that. And of course, in those early days, that's where all the losses are made because most of them don't survive. They go broke or they lose your capital. And 9 out of 10 or probably 99 out of 100, that's what happens to them. So we're not interested until they pass the point of consistency and proving their business models. And we want strong moats. So the moats are critical. All the big tech companies and the Magnificent Seven all have very strong moats. They tend to dominate the sector they're in and they have all the customers. Very, very difficult to displace them once they're in that position, even if you come up with something a lot better. And I always think the good example of that's Apple. Apple's got, we're an Apple household. We've got 22 Apple devices in our house. My wife and I both have Apple phones. I'm on probably my 15th. I get every second issue that comes out. I don't replace it to every model. It's every second model. And she does the opposing one. I don't give a rat's about Samsung. My son has Samsung phones and, was showing me his fold phone. And I don't care whether it's better. I'm never changing because I am totally locked in. It's a trapdoor mode. I am locked into the Apple ecosystem. Everything is connected and it all works. They can charge me basically whatever they like and I'll pay it. That's a moat. So Apple's also got about 2 billion customers around the world, and it's got 1.2 billion are now on subscription service offers. So they're paying an ongoing amount, even if it's a small amount, to Apple every month. There's 1.2 billion of those. These are massive moats. So, and that goes to sustainability of earnings going forward. And it's a key criteria of all the companies we're talking about today. Also, trustworthy management. And I'd go further than that and say what we want is management with founder mentality. We love founders. Founders who have massive skin in the game are going to have absolutely aligned objectives and incentives to us as shareholders versus a hired gun who comes in and basically they're maybe there for 5 years and is very much focused on his exit and what his bonuses are going to be and so on. We want founder mentality and preferably founders. Interestingly, all the big tech companies are still largely run by founders. So Berkshire Hathaway and tech investments. In recent years, Todd and Ted Weschler, and these are the two anointed executives within Berkshire who are going to run the listed portfolios for Berkshire once Buffett dies. He won't retire, so he won't stop till he drops off the perch, just like Munger. And Berkshire now invests in several tech companies. In 2016, they started buying Apple. Now, it would have been Ted or Todd originally, but they actually shifted Buffett's thinking around. And it was very interesting. In the, I think it was the 2019 or the 2020 AGM, Munger, who was hilarious, he's a massive loss. He really is. And he actually said to the shareholders at the beginning of the AGM, and there was 35,000 there, and he said, maybe you shareholders should all think about selling your Berkshire shares because maybe Warren's gone nuts. He's either learnt from his mistakes or he's off his rocker. And then Buffett chimed in and said, I hope it's the former. And then Munger went on to explain, and he said, we own dozens, I think I can't remember how many there were, it's probably 40 newspapers or something in the Midwest and so on they'd bought up. And he said, we sat there watching Google taking all our advertising revenue away from us. And the advertising revenue in newspapers was always called the rivers of gold. This is all over the world, by the way. So, and we saw Google taking all our ad spend, and we watched. And then we saw them running a proper business with proper return on equity and profit and all the characteristics that we look for in a business. And we sat on our hands and we watched and we did nothing. And he said, look, all I can say is we apologize from the bottom of our hearts to the shareholders because we have literally cost you tens of billions of dollars by not adjusting our thinking and changing from this black and white position of saying we didn't invest in tech. So now they've changed, of course. Apple now, their shareholding in Apple is now valued at 168 billion US. It's about over 200 billion Australian, and it's 47% of their listed equities. So in other words, 47% of Berkshire Hathaway's total listed portfolio is in Apple. And last year at the AGM, he said, Apple happens to be a better business than any we own. So out of anything they do, he said, Apple is the best business. That was at the AGM. In 2019, Amazon was first purchased. It's now about 1.5 billion. It's not massive, of course, but he said, I've been a fan and I've been an idiot for not buying. And he said that in May 19 in an interview on CNBC. So there's no egos with either of them, with Buffett, and he calls out any mistakes they make at the AGMs, and they never hide from anything. So they said, we guarantee you we'll make new mistakes every year, but we get really angry if we ever make the same mistake twice. Wouldn't that be nice if we could all do that as investors? Never make the same mistake. I mean, it's like Groundhog Day sometimes. I try hard for it not to be, but it still happens. Other Berkshire tech investments, Snowflake, which is data, cloud control and security software, HP, it's the old Hewlett-Packard, personal computing, printers and gaming, and then even New Holdings, which is a digital bank in Latin America. So they're starting to become more adventurous and start moving further and further out of the US. Now, this was a 1999 Fortune magazine interview. Buffett said, the key to investing is not assessing how much an industry is going to affect a society or how much it will grow. Now, this is obviously a big part of what AI discussions are all about now. How is AI going to affect society? And is the industry going to grow? Well, yes, the industry is going to grow. But he says, but rather, it's determining the competitive advantage of any given company and, above all, the durability of that advantage. So this is going back to building moats, and it's about individual companies. So that should be the focus, not the industry. Who cares about the industry? I don't even want to get into a discussion about whether our robotic overlords are going to take over in 20 years. we are not turning AI back. This is out of the bottle now, and it's mainstream, and if any, a lot of it's open source as well. The products or services that have wide sustainable moats around them are the ones that deliver the rewards to investors. And it's true. You look at Coca-Cola. He's been invested in Coca-Cola for, I think, 35 years. And he said he's willing to take a bet from anyone now that Coca-Cola will be selling more bottles of drinks, whatever they are. Remember, they have water, they do all sorts of things now. It's not just Coke, in 10 years' time than they are now. In other words, they're not going anywhere. They've got a global brand and a massive dominant position, which everybody's been trying to undo. And they've got competitors, of course, but Coke's not going anywhere. These are strong moats. So it's all about moats. We are really big on moats and understanding them. Okay, that was 99. Now, I think this is totally applicable now. This is 99. We're now 25 years on from that quote. It has not changed. That is a perfect quote to consider how AI and tech is coming into the world. Doesn't matter how it's coming in as a concept overall. It's what businesses are going to prosper. So there's a little funny AI cartoon I liked. The AI is going to infiltrate our lives everywhere. I am really looking forward to Apple bringing out a like Siri number 5, version 5. I think it's going to be in June, which is going to be like an agent. So if you let it, your choice, it'll be able to learn everything about you, what you like, what you don't like. And so when you ask it something, it'll frame it knowing you better than you know yourself. I think it's going to be fantastic. But anyway, we shall see. So profiting from AI. Well, it's nearly impossible to pick which of the 57,000 odd AI companies are going to become billion or even trillion-dollar businesses. Interestingly, Elon Musk recently said that he thinks the first individual trillionaire, so not company trillionaire, individual trillionaire will be out of AI. And I suspect he's sort of glancing in the mirror when he says that, because he's the closest to it. He's got something like, I don't know, 300 billion or something now. So it's quite possible he could be the first individual trillionaire. There will be one I reckon definitely within the next 10 years, and maybe in the next 5 years. Even I remember it was not long ago when we were all debating which company was going to be the first trillion-dollar company. Now we've got lots that are multi-trillion. I mean, it's just quite incredible. Okay, so it's easier and safer to consider how existing profitable businesses can exploit AI technologies and grow earnings, strengthen their moats and mitigate business risks more successfully than their competitors. So our view in Team Invest, and we've done lots of deliberation on this with Team Invest, by the way, is a collaboration of the 600 people. We facilitate it. So we believe that over the next few years, the serious money is going to be made in existing businesses. Now, this does not even mean tech companies. I'm talking about tech and AI tonight because that's the sexiest end of it. All businesses are going to be impacted by AI. And I suggest if you're going to be a serious investor and want to do really well over the next 5 and 10 years, you need to see how your businesses you're investing in, how they're applying it, and whether you think they're going to be able to be on the winning side of it. Because I believe that in 5 years, we'll have businesses that are using AI effectively in the businesses, and businesses are out of business. That's how significant it's generally going to be, I think. Okay, so when is it safer to invest? How can you pick winners? We'll start by being patient. Don't try and get in early. The speculative frenzy that we had in the 90s, the late 90s, burnt an enormous amount of wealth and people's livelihoods and retirement savings. It's going to be the same thing again. This is going to be a hypey market. And there's going to be, as I said, it's 50-odd thousand. There's probably another 50,000 since then, by the way, that have started. Once an exciting company has demonstrated it has a viable business model and has a consistent revenue growth for a start. So we're not talking about how many accounts you have. We're talking about making money. So the revenue is growing strongly. And once they've got about 5 years of that, you could consider investing a small amount if you want to. And then once it's generating rapidly growing profits and is running a proper business, and while clearly building a strong moat, so you need to be able to see what that is and see that it's a dominant moat. Quick example, we looked at realestate.com when it listed. I can't remember exactly how many years back it was, 18 or something. It was $2, I think, at listing. It clearly by year 5 was showing that they were going to be the dominant player in the industry. It was profitable, high return on equity, stable earnings, no debt. and it was $7. So it had gone from $2 to $7 over about 5 years. And at that point, we started looking at it. And unfortunately, most of our members didn't invest in it because of News Corp was the major shareholder and owned 61%, and they were worried that Rupert Murdoch might do something to disadvantage the minority shareholders. It never happened, by the way, and it's been a spectacular return ever since. But the point I'm making is you didn't have to buy at the beginning to make the big money. You made the big money by buying it once it was proven. This is exactly the same. So invest more, and then you can invest more in and average in over time is a really good strategy rather than trying to time the market. And I'm going to show you some examples on why I think trying to time the market is a total fool's errand, and you don't need to do it to get a 20% compound return. That's the good thing about it. You can be actually patient and conservative and not be heroic to get those returns. We're not trying to shoot the lights out. I don't want to lose my capital. I like the idea of compounding it at 4 to 6 times every decade. So if you get 20% average, that is 6 times. If you've got $1 million, you've got 6 million, you've got 6 million, you've got 36 million. It's an incredible thing, the power of compounding. So averaging in when the PE for the particular company is in its the bottom quartile of its range. All companies have a range, and it's just a matter of understanding that. So the Magnificent Seven. Had a long listed histories. Tesla is the most recently listed in 2010, and they have the scale to develop and exploit and acquire emerging generative AI technologies. For instance, NVIDIA, which makes the GPU chips and currently has an estimated 80% market share in AI processing and data centers, and software called CUDA, which makes the whole thing work, which is a big deal. It's not just the chips. For implementing and managing generative AI. I'm going to show you NVIDIA. It's an incredible success story, and I think it's early days. Microsoft, OpenAI, they have done a deal with OpenAI, so it's part of their business largely. Copilot is their AI product they're selling to corporates, and they're going to charge they're looking at charging an extra $80 or $100 a year per seat to have their AI support for staff. And they've given it to them so far, and the employees of the big corporates, which are their biggest clients, are all using it. That's worth tens of billions of dollars alone in revenue and profitability and profit for Microsoft, just on Copilot. Azure are their data centers. So Microsoft's second to biggest data center cloud computing processing in the world. Amazon's still bigger. Google's quite a long way behind. Amazon, AWS is their data center, targeting online sales with AI. Alphabet, generative AI, targeting advertising, smarter search. Apple, generative AI embedded in mobile devices and personal security. By the way, I believe Apple is in one of the strongest positions to capitalize on AI. Microsoft is as well, and obviously NVIDIA is in it at the time. Meta, which is the old Facebook, generative AI applied to social media and networking apps. And Tesla, AI enhanced autonomy and robotics and all sorts of things. Musk is a genius, and I wouldn't bet against him getting us on Mars within 20 years. Okay, so Magnificent Seven. In 2023, the US S&P 500 was up 26.4% return, but 2/3 of this was due to only 7 companies. So think about that. 2/3 of the total return on the S&P was 7 companies, all leveraged to AI and tech. Apple, Amazon, Alphabet, Microsoft, Meta, NVIDIA, and Tesla. So now what you're looking at here with these numbers, and I'm sorry to give you lots of numbers, but I'll just show you. Strat-D is our measure of stock return with dividends reinvested. So this is saying, what do we think the EPS, what the earnings, the return you're going to get if you bought it today based on our default metrics. So we're saying Tesla we think is going to return 45% a year over the next 5 years. NVIDIA 42%, Microsoft 30%, Google 25%, Apple 21%, Amazon 19%, and Meta 8.76%. So interestingly, all of those, apart from Meta, pretty well 20% or more is our base case of what they're going to do. Next column is their current PE ratios. And now this is not forward PE, this is trailing PE. That's how we do it. And you'll notice there, the highest one is NVIDIA at 73. they have the highest growth rate. They're currently growing their earnings at over 100% a year, which is a bit hard to deal with in our system. But I'll come to that in a minute. They're on a 73 PE. That's the highest. Microsoft's on 37. Google's on 23. Apple's 26. Amazon's 61, which is the second highest one, and Meta's on 30. Now, those PEs you might think aren't that high compared to Australian tech stocks, and you would be right. Now, return on equity, remember we want 10% or more, all way above it. So they've all got very strong return on equity. None of them have high debt except for NVIDIA at 76, which is right on our level. We work on 75% or less. NVIDIA has been investing an enormous amount in R&D and chip design and so on, but they're turning it into massive growth. So I don't begrudge them that. That's very manageable. And based on their cash flow, their payback period on the debt is very, very short. EPS high growth. Now, what that is an algorithm we have over the last 6 years. So I was looking at the earnings for the last 6 years and working out how stable it is, what they are, and what it's likely to do going forward. So we're giving them, this is what conscious investors giving them. So Tesla's got 19, NVIDIA 43 is the highest, Microsoft 23, Google 14, Apple 32, Amazon 43, and 14% for Meta. So all good. These are all excellent growth rates. So that's our view of what the average growth rate is going to be over the next 5 years. The earnings stagger, that's how stable are their earnings. Now, remember I said at the beginning, we want high stability in earnings over time is our best predictor for the future. Look at the earnings stability, 88 for Tesla, 65 for NVIDIA, Microsoft 89, Google 87, 78 for Apple, 56 for Amazon, and 49 for Meta. They've actually, both of those have had a challenging couple of years, so it's below on their averages a bit. Sales hates growth. This is the same thing. Sales are all growing strongly as well. And you even look at the relationship between the sales and growth. See, Tesla's EPS growth is growing faster than its sales growth, meaning they're extracting more out of every dollar of profit as they get bigger, which is terrific. Now, it's easier for a company like NVIDIA or Google or Apple to do that. So what's Apple's? Apple's stability is 98 and its sales growth is 15 when its EPS growth is 32. So in other words, it's growing its earnings at double the rate of sales. And the reason they can do that is Apple's a very capital light business. They don't make their own chips. They contract them to Taiwan Semiconductor and so on. And they have very high priced products. And I read once that Apple in the smartphone market, don't quote me, was something like had 8% in global smartphone market share, but they made 80% of the profits generated out of the whole industry. And the reason is there's a lot of smartphones that sell in Africa and everything for $50 and so on. So Apple, with their positioning and their loyal fan base and their customers, can extract much, much, much higher prices than any of their competitors and still keep growing at these fabulous growth rates. That shows you how strong their moat is. So yield, you'll notice there's virtually no dividends paid by the US companies, and there's a good reason for that. In the US, they don't have franking credits like we do, so you don't get a credit on company tax. So it's far more tax effective for investors, for the companies to use surplus cash to buy their shares back, reduce the number of shares outstanding, which increases the capital gain you make on the end when you sell your shares. That's discretionary. So sorry, the capital gains are like ours, where as long as you've had it for more than a year, it's 50% discount. So that's far more capital efficient for the US firms, which is why their dividend rates are so low. And the market caps, interestingly, the lowest is Meta at 1.2 trillion, and the highest is Apple at 3 trillion at that point. Now they move around a bit as well. So Tesla's come off a bit lately, so they've been out of favor, but who cares? I'll show you why. So current large tech companies will be the early winners in AI, we believe, and I'm sure we're right. By the way, we have a very strong view on this. They have the customers, they have the network moats, so they have the biggest data sets to feed the AIs. You think about what Tesla's got. They've been running hundreds of thousands of cars running around filming everything. So if you look at visual data of the world and places and so on, nobody's got anything like Tesla has. So there's so many ways they can ultimately exploit that down the road. They have the financial strength to invest heavily. So there's literally hundreds of billions of dollars being invested into AI and technology at the moment. It's on you see it with the NVIDIA chip sales. They cannot supply, and they're making absolutely humongous profits because their technology is the best and everybody wants it. And there are clear paths for additional income streams and profit with these companies. I won't go into them now because we haven't got time, but they all have very, very clear ways that they're going to be able to leverage their AI investments to increase the business very, very quickly. So they're in capital spend at the moment, but over the next year and 2 years and 5 years, you'll see their earnings jump. I think their earnings will increase on what they've been. But even if they don't, and they just maintain the same trajectory that they have now, you're getting 20% plus returns. So let's talk about timing the market versus time in the market. Now, we're not passive as in leave your money in the market. We're talking about being invested in the best quality businesses and then buy them at the right time and then stay there is the key thing. So Buffett said, if you want to dance in and out of the market, I will be happy to be your broker, but not your partner. He said that years ago, and it's still true. Compounding is the eighth wonder of the world. Albert Einstein said that, apparently. And there's been lots of other people who've had similar quotes. It's a fantastic thing. And it's like, it either works for you if you understand it, or it works against you if you don't. In other words, be a lender rather than a borrower, put it simply. And Charlie Munger said, the first rule of compounding is never interrupted unnecessarily. So if you look at all compounding charts, all exponential charts, we cannot work it out in our heads. Our brains can't do it. They all go slow, fast, straight up. And if you look at Berkshire Hathaway, Warren Buffett's, I think it's about 90% of his total wealth has been generated in the last 10 years because of that compounding. And he's been giving away about $7 billion a year to charities every year now. He's giving basically all the wealth away when he dies, mainly to the Gates Foundation. And his wealth's still increasing because he cannot give it away faster than he's making it because of compounding. It's just a fabulous thing. So let's look at Apple. This is Apple since, I just picked 2000. Well, there was no magic number about 2000. 2000 to 2024. This is 24 years of Apple's history. It's actually gone up 17,162%. The share price has increased since 2000. Now, what that means, this is where the compounding, now that sounds like a big number, but what is it really? Well, it's actually 171 times your what you invested. So if you put $10,000 into Apple in 20, now I look at it, and that for me, I was 44 in 2000. I could have put $10,000 into Apple at all. I had a very successful business, but I didn't. I was busily investing in Australian gold explorers and so on back in those days. That was well before I learnt the merits of investing like Buffett, and we started Team Invest. And of course, I've changed since then. 10,000 invested is now 17.16 million, just so you know. Now, okay, that's a fantastic number. But if you look at that chart, look, there's lots of ups and downs, and there's periods where nothing much happened. So isn't that a typical chart of any exponential company? So let's look at the next one. So this is cutting where those squares are, of then blowing that out. So that little drop there, which was about 2013 to 2014, so 1 year, Apple was down 41%. Now, what do most investors do when that happens? So a share price starts going down. If they have stupid thing called stop losses, they get stopped out. So they then sold it. They don't own it anymore. Compounding stopped. So, and then they're going to buy it back. When do they buy it back? Probably not here, maybe there. And then it drops again, they sell it again. So maybe they make a bit of money, maybe they don't. You could have bought and sold Apple lots of times over the 24 years and not made any money if you acted like a trader and the way they do it. If you held through, you would have the $17 million for your 10,000. So look at these periods. That one there, short sharp drop in 2019, it dropped 33.9% in 2 months. Would that spook you? Now, it doesn't spook me, because all that's happened is it became a fabulous buying opportunity. Because when these prices drop like that, the PE is going down. And it was interesting. that we bought Apple here on this one. And at that point in Team Invest, it passed our filters and we did a smart, we call it, which is when we do an in-depth analysis of a company. We ran it in Adelaide and the share price was $84 at the time. And there's been share splits since then. And it was on a PE of 9. So Apple, arguably the number one brand in the world, was available at 9 times earnings, and it had at that time $300 billion in cash offshore, just sitting there in undeclared profit as well, and no debt. And you go, what's wrong with this story? My big mistake was I only bought a small amount. I've still got them, and they've done astronomically well. But the fool I was, if I'd only put in a significant amount of money, I would be enjoying these massive gains we're talking about. Anyway, so 33, 27% there. Look at that. Up, down, up, down. So if you do stop losses, you're screwed. They're an absolutely nuts idea, guaranteed in my view, for you to lose money. And it's like you're cashing in your losses rather than letting your profits run and keeping it going. So look at all that. Look at the volatility there, massive. But so that was up, down, up, down, up. But if you just stayed there, you've done brilliantly well. So let's look at the next one. This is the other side, the rises. This one is that one is 774% between 2009 and 2011. Okay, that's nearly 8 times in less than 8 years. And then next one, look at that, 2014 to 2018, 283%. Bit slow for Apple during that period. And then look at this one, 377% in 1, 2, 3 years between 99 to 2022. Then it dropped a bit, and then it's back up again to where it is now. So the point I'm making is if you do stupid things like stop losses, you virtually guarantee not to make these gains. So the argument with Apple has been any time you bought it, you've done really, really well. And I believe that'll continue. I think Apple, as I said, is one of the best companies and has the most leverage to artificial intelligence. And I won't go into why, because it's a whole, that's an hour webinar on its own, but it is very, very exciting. Okay, so let's have a quick look at what about ASX listed tech companies. Now, this is interesting because some of our well-known ones, and we're shareholders in these, Pro Medicus has a stretch here. That's a stock return with dividends reinvested forecast for the next 5 years, which is our using our conscious investor program, is 34% per year. Its current PE is 146. WiseTech Global 144. T&E, which is one of our favorite companies, 55. Altium, which is just being sold to private equity, was 82. Now, you notice there was no PEs like that on any of the US higher growth companies we talked about. And generally, their growth rates were higher than ours. So if you look at these, the EPS H growth is the forecast growth of earnings over the next 6 years. Pro Medicus is 36, 35 for WiseTech, 13 for Technology One, and then we've got these others like NextDC and Xero and so on, which lose money. So they have nothing. So high earnings stability in these. So these are quality companies and we're invested in them. So they've been good. Technology One has been a brilliant investment for me. I invested it initially about 14 years ago. I think it was 14. It was 98 cents. It's now, I don't even know what it is because I don't follow it. I think $15 or something plus dividends. But the return, long-term total return is over 90% a year. Yeah, because of I bought it at 90 cents, now 12 plus all the dividends all the way through. So it's been spectacular, but it's on a 55 PE, which is too high for its EPS growth rate, which is very, very good at 13% and very, very stable. So, right. So many tech companies are on high PEs, anticipating strong future EPS growth, and some make little or no profit, including Next DC, which is a data center group. I don't know why people pay so much money for it. It's a $9 billion business and still loses money when you can invest in quality businesses that are making really good money, and you're not waiting. Xero is another one. It's now a $20 billion business, and it's still losing money. It made a little profit for about, I don't know, a month or something's gone back. I don't think they want to make a profit, because as soon as they start making profits, they'll have a PE ratio, and the PE ratio is going to look horrendous, and then it'll get revalued down, because with no earnings, how can it be worth 20 billion? Even though it's grown really well, it's got high stability of sales. But look at the let's see, there's no EPS because they're not making a profit. Their sales per share are growing at 24%. So it's growing, sales are growing, but they still can't make a profit. Now that's fatal when you have a major market downturn or a really big recession. You get taken out when you're like that. So anyway, just saying. So, okay, consider the PE differences between US and Australian companies. US Nvidia is on earnings per share of 43%. By the way, their earnings per share are growing at over 100% a year at the moment. This is our forecast based on their average over the last 6 years. So PE 73, total shareholder return 42% per year is what our models in Conscious Investor are predicting Nvidia will return over the next 5 years. Microsoft, 32% EPS growth, 37 PE, 30% return. Apple, 19% EPS growth, 26 PE currently. These are current. 21% total shareholder return. Amazon, 15% EPS growth, 61 PE, 19%. And Meta's 15%, and that's Facebook, and 30 PE at 9% total shareholder return. Now, compare that to Australia. Just look at that. And then I've just picked some of our best ones. PME, Pro Medicus, is EPS growth, which is a fantastic company, by the way, is growing at 36% a year, and it has been accelerating. Global business, but it's on a PE of 146 times earnings, and has a total shareholder return of 34% a year if it maintains this PE. Look at the PE differences. It's double. They're double, at least double or triple. WiseTech Global, 35% EPS growth, but 144 PE. This is what we're paying in Australia compared to what you can pay in the US for the same earnings. We're paying double to 4 times the price for it. Now, there's a risk in that, because if there's a change in the business and the earnings drop for whatever reason, something happens, the PEs have a lot further to fall. Let's put it that way. T&E's 55, total shareholder return 34, 25, and 11. Zero, because there's no earnings, and NXT 0 as well. So right. So some conclusions. How are we going for time? Generative AI will automate much white-collar work, expertise in a machine, and it will affect virtually all businesses. It's easier to invest in profitable companies that can grow earnings and strengthen moats using AI than pick a few winning AI startups. And the key to investing is not assessing how much an industry is going to affect a society or how much it will grow, but rather determining the competitive advantage of any given company, and above all, the durability of that advantage. So if you haven't ever read any of Buffett's things, I really recommend you do, because he has been the most successful investor in history, and he's continuing to do it at his ripe old age of 94. I'm thinking I should know that. And what he's done is he's distilled the things that really make the difference on what happens, which we mercilessly have copied. So it's about the businesses. You've got to look at individual companies. Even the sectors doesn't matter, really. It's about the individual companies and what they're doing. So we've got a Buffett report, which will give you a very, very strong history of how he evaluates companies and how we do as well, and how that you can use that in your investing. And I would absolutely recommend you get that. And there's a barcode on these, so you can scan that, or it will be in the chat as well. So I'm pretty sure, and you'll be able to get a copy of that, which I recommend. And I think we've got time for questions. So I'll just put up the Q&A. Actually, a couple of my members asking questions here. Athena, after decades and booms all crumbled, so why should I believe this? Well, so Buffett's built it'll be a $1 trillion business. It's actually probably in Australian dollars, Berkshire Hathaway is a $1 trillion business now through investing over a period of, what am I thinking? It's nearly 60 years. So that's why. So all booms and busts change, but the companies that are high quality will actually go through the booms and busts. But if you follow the rules, Athena, you won't have a problem. But you can make losses in the short term. What counts is the average over time. Following your wealth winner rules means you would not have invested in Atlassian. That's true, you wouldn't have, because we only invest in profitable businesses. We don't try and make every dollar. What we're interested in is investing only in the companies that we have a very high a confidence level in the probabilities of what we're going to receive as a return. So we're not trying to capture every profit. I would argue a lot of the prices of a lot of companies like Atlassian are not based on they're very difficult to put a value on it because they don't make any money. What are the key indicators that reflect a strong moat? Well, it's a big subject, Simon Hill asked. There's lots of different kinds of moats. There's a trapdoor moat. Give a quick example on a trapdoor moat. Technology One has a trapdoor moat where once you're in, you can't get out. In other words, your business has to adapt so much using the software because it integrates right through your business that you can't change. Now, Microsoft has as well. These are all businesses that have very strong trapdoor moats, very hard to get out once you're in. So that's one type of moat. Moats go to sustainability of earnings. So you can read up more about that if you look at our website. Athena, will a mining company, e.g. Whitehaven Coal, gain or lose from AI, and will AI matter to them? Good question. Mining companies, we tend not to invest in mining companies, and the reason is they are price takers. They can't control how much they're going to earn. Depends on what's happening with coal, for instance. I mean, I'm quite optimistic about Whitehaven Coal long term, but it's not as predictable as a company that is making widgets or has a very strong moat on their business. Mining companies are challenging, so we tend not to invest in them. So on that one, the market caps look out of order for the Magnificent Seven. Okay, maybe. I think compared to Australian companies, they're generally not. But also you've got to buy them at the right times. Like as I said, Apple got down to a PE of sub 10 once, only once. And you don't buy them when they're on high PEs. What I'm arguing is the businesses themselves will keep growing. You then need to work out how much you pay for them, and really even buying them generally in the bottom quartile of their PE range. Remember, PE is based on price over earnings. So we're talking earnings, not hope, is a pretty reliable way of doing it. But that's obviously what we do, is we work out what do we think the earnings are going to be going forward? How stable are they? How long can we predict into the future? Mining companies are difficult by definition because they're price takers. So mining is very difficult. We tend not to invest in mining companies generally. It isn't true for tech companies. The pioneers take the benefits and settlers carry the risk. Sometimes. And there's been plenty of crooks and charlatans in tech companies, or any company for that matter. It doesn't have to be a tech company. Go back to the railroads back in the old days. We have to trust the management. So a big part of what we do is looking at management, skin in the game, history, and get to know them, look at what they say, look at what they do, and work out whether we trust them. So we're not speculators. We are very, very deliberate value investors, and we follow Buffett's methodology because it's the best, and it's been long-term proven to deliver outstanding results, and it has for us. What's Mark's view on Snowflake? Is he reinvested as the share price falls? Sorry, I don't know. I haven't. I'm aware of Snowflake, and I don't know. I've never looked at it. Are you going to use AI to improve your share selection and timing? That is a very good question. We are using AI, and we're not using it to choose companies. but we're using it to analyze what management say, what they've done, how that compares with the realities and what they say later. There's a whole heap of ways you can use AI that can be very, very useful in analyzing a company. It's also very useful if you go back multiple years then to see what was said and so on. And we're not using it to pick the winners though. I don't think AI is there anywhere near there yet. I think our models are much stronger, but yes, we are. We're definitely using AI. Kerry said, how did NextDC and Xero get past your wealth winner rules? Xero has never got past our wealth winner rules. So Xero is a company that makes no money. And it's an interesting company. It's been growing incredibly well. And it's got a very high market cap, but it fits into one of those companies that doesn't even get close to passing our filters. NextDC doesn't either. So I don't know why you think they do, Kerry, but they definitely don't. Brett said, do these prices keep you out of investing new money into the company studied today? Love the work. Keep it up. It's greatly appreciated. Well, thank you, Brent, sorry. No, it doesn't keep us out of investing in the companies today at all. The way we do it, our whole process is to work out what the moats are. Do we trust the management? Is their business model sustainable? And what are the risks? How likely are they? How stable are the earnings? How likely are we to get what we think we're going to get, which is a combination of dividends and capital gains and the benefit of share buybacks, perhaps, particularly with the American companies. And then we work that back and then say, okay, well, how probabilistic is that? And what are the risks associated with it? And then we look at a margin of safety and then work out what's likely. All I'm saying is that the US tech stocks are looking like they have another whole lease of life because of AI coming in, which I suspect will go for another decade or more. And I think most of those companies I talked about will all double or triple again over the next 10, 15 years. So it's very exciting because back in the old days, companies used to get too big and they couldn't keep growing because they tend to dominate a market. That's not how the dynamics of these markets are working anymore. So the riches are going to a small number of companies, and there'll be new ones as well coming in. But I'm very not only invested in them, I'm very bullish on their ability to keep earning. But we watch them like a hawk and so on. Any tech and AI ETF? We don't do ETFs. We only invest in companies, Jose. But there are some. There's one I did see called, which I thought was interesting, called what's it called? It's actually an index fund you can buy in Australia, which is just the major FANG stocks. I think is it called FANGs? Sorry, I'll think of it. If I think of it, I'll tell you. But so you can invest in them through an ETF, actually, which is just focused on those high growth tech stocks. What are your thoughts on ETFs like FANG? There you go. To take advantage of all Damien's asked. Look, I think ETFs like that, particularly where you go for the select ones, the FANG, that FANG must be the one I was thinking of. It's a good way to do it because you're actually going to get an average, if they have equal weighting in them, of the performance of that ETF. And it's easier than buying direct shares because if you're buying FANG stocks in the US, you've got to then have an international brokerage account. You've got potential tax issues. There's some complications in it. I'm more than 50% invested internationally, not just in the US, but other markets as well. So, then I just have to pay the accounting and stuff to do that. But it's the ETFs where you can get a subset of an area of the market that's doing really, really well, like the FANG stocks, and I think they'll continue to do well, is a good way to go. It's a nice, simple approach, and it's better than buying an ASX 100 or something like that. Okay, so I think we are just about out of time. Do we have any other questions? I think I've got them all. There's a few more. Can you come along to a Team Invest meeting as a guest prior to joining? Not really, but we do have a guarantee. So that if you join and you don't like it, we give you your money back. Roughly how many shares would a Team Invest take on per year? How many shares would Team Invest take on per year? Well, we work on a filter system. Our Conscious Investor program basically filters all companies, and we do all markets, by the way, so we have global shares. Most of our effort is on Australia and the US, but we are slowly expanding into other markets as well. But our filters run all of John Price's filters on each company and score them and so on. So that's exactly what we do. And so we only look at the ones that pass. So if you look at the ASX, there's about 2,200 companies on the ASX at the moment. Currently, if I put a zero rate of return, so in other words, I'm not trying to make money, how many pass? There's about 60 out of 2,200 that pass at zero return. If I want a 10% return, there's a lot less. And if I want a 20% return, there's less again. There's a lot more in the US because it's a much more bigger liquid market than we have. But that's how we do it. So we're actually we focus on about 20 companies with the occasional one going out and the occasional one coming in is basically what we do, because what we target is 20% compound return and or better, and it works really well. So I think that's pretty well all the questions.
I think
Okay.
just making sure.
Thank you, Emily.
All right, thanks, Mark. I mean, this was extremely insightful. I hope that this last hour has been a good addition to just unpacking your investment journey, just a good addition to navigating this complex landscape of just tech and AI. I've just popped in, so in case you're not able to scan this barcode up on the screen, I've just popped in some helpful links in the chat. So there's a link again for the Buffett report, along with an email address to send in your questions if you have any. Again, a copy of this webinar will be sent to you after probably tomorrow or maybe in a few days, and it will also be live on our YouTube channel.
And actually, just as well, I'd like to add, and I meant to say it at the beginning, I forgot. Sharesight's terrific, and we all our members use it. Well, I say all, we've got probably 80% of our members use Sharesight because it gives you a much clearer total return picture on what you're getting. Because what people make a mistake of sometimes is they look at their statement from their broker, and it shows what the capital gains are, but it doesn't include the value of all the dividends as well. So what Sharesight does, it gives you a true total return, and you can select reinvest dividends. Now, whether you do or you don't in reinvest dividends doesn't matter. But what it does, it gives you a much better picture of what your real returns are, and it's really different to do that. See, otherwise, that way you don't sell something thinking I'm not getting that good a return, whereas in reality you've had a really good return. So we find it really useful, and the vast majority of our members use Sharesight to track their portfolios and to get a clearer picture of what's working. So we recommend it.
Thank you.
You're welcome.
That's really nice. Thank you, Mark.
Okay.
I've also popped a link in there if you want to sign up to a free Sharesight account if you don't have one already. And that's probably it from us today. Good night. I hope you have a good rest of your evening. Thank you for joining us and taking the time out of your day. See you at the next one.
Thank you very much. Good night, everyone.